All right, so let's look at the meaning of shared value. Shared value in the context of corporate social responsibility. So usually, corporate social responsibility is seen more from kind of like helping people in the community, making like some social, philanthropic, um, you know, some social philanthropy, things like that. But with shared value, it's more of a business term. So it's practices, policies that enhance the competitiveness of a company while also advancing the economic and social conditions of the communities that it operates. So it focuses on connecting social progress and economic progress for organizations. So when an organization comes to a particular location, it's able to look at the needs in that location and also merge meeting those needs with enhancing the competitiveness of that company. So, what are the components of the triple bottom line? You have a firm's financial, social, environmental, also people, planet, profit. Now, strategic drift is when there's a gradual decline of competitive ability for an organization that results in the failure of that organization to recognize and respond to changes in the business environment. So many times the strategic drift is either that the company is not mindful of the changes happening in the industry and is not responding quickly. There's no agility to the changes happening in that industry, and things suddenly change and the organization finds itself left behind, and they're too slow and they're not able to catch up. All right, so this is a good example of the difference between corporate social responsibility and creating shared value. So with corporate social responsibility is more of addressing societal needs, giving back, doing less harm or doing no harm, doing good, discretionary response to external pressure. There's no relation with business competitiveness. It's separate from profit maximizing. It's more on doing philanthropic endeavors. The agenda is determined by external factors and often personal or department preference. Then you have no real influence on innovation other than incremental, operational and tactical issues. It's scalable, but from a cost perspective point of view, it's seen as a cost and legitimization of operations for investors. You have to legitimize it to the investors. It's seen mainly as a cost. Now for shared value, it's more of addressing societal needs and challenges with a business model. So now you're not just looking at, oh, let's just throw out some money, but let's find how we can both help the society and also have it as a business opportunity. So doing well by doing good, integral to competing, it propels competitive advantage in new unlocked markets, integral to profit maximizing, agenda, company sector, and market specific. It initiates radical innovation and incremental innovation at scale. A good example is if Adidas goes to a country, and in that country there are not enough shoes. And rather than just selling the shoes they already have, they begin to have a factory there that creates shoes for people. People have jobs, so people are able to have shoes, or where there's no water, and the company creates water and also charges a little fee for that water, something like that. So when you're doing societal good as well as increasing your business competitive value, that is where shared value comes in. So it is a strategic priority. It's at the heart of the business. It's scalable with profit increasing. It's seen as commercial opportunities for investors. All right, so I want to talk about vertical integration and horizontal integration. With vertical integration, what you have is the supply chain is being integrated, whether that's through mergers or acquisitions. So purchase of companies at all levels of production. So I personally like this picture because it shows you how there's a cattle farm, there's a slaughterhouse, all these are separate businesses. But vertical integration, but they're all in the supply chain. The cattle, the meat, the slaughterhouse, the refrigerated railroad cars, the cold warehouses where you have the meat packing plants, the delivery wagons, and then the meat industries. When these different businesses begin to join together, merge or acquire one another, that is vertical integration, acquisitions in the same supply chain. purchase of companies at all levels of production. But horizontal integration is purchasing your competitor. So Facebook purchased WhatsApp, and Facebook also purchased Instagram. That is a good example of horizontal integration. And a good example of vertical integration is IKEA that sells furniture, purchasing like forest or places where they can get wood, which would have previously been their supplier in the supply chain or levels of production. That is vertical integration. Horizontal integration, purchase of competing companies in same industry. So US oil company, independent oil refineries, these are all competitors. They all merge together to form this US oil company. When it's competition, merging and acquiring, that is horizontal integration. When it's a supply chain or production where you have mergers and acquisition, that is vertical integration. All right, so here's a question that says another term for profit and loss statement is the income statement. So that's a synonym. The income statement is also known as profit and loss statement. It's a financial statement and it shows the company's income and expenditure. It shows whether the company is making profit or a loss for a given period of time. All right, so this is what an income statement looks like. As you can see, it shows you the cost of goods sold that we talked about previously. It shows you the gross profit, the operating expenses, sales operating expenses, non-operating expenses, and it shows you the net income. So income statement, it shows the revenue, expense, profit and loss of a company over a period of time. The profit or loss is determined by taking all revenues and subtracting all expenses from both operating and non-operating activities. All right, this is about an example of the balance sheet. And you see that the income statement, it talks about 3 months ended September 30. So income statement is usually for a period of time, for a stretch of time, whether that's a quarter or whether that's a year. But the balance sheet just gives you a specific point in time. So it will be reported on a particular day. And you see here in this question, we have December 31st, 2100. So balance sheet, on the other hand, will show you the assets, then shows you the liability and equity. Now, the liability plus equity is equal to the assets as well, right? So a balance sheet gives a statement of a business's assets, liabilities, and equity at a specific point in time. It offers a snapshot of what your business owns or what it owes, as well as the amount invested by its owners reported on a single day. All right, so this is an example of a cash flow statement. So this is an example of a cash flow statement, what a cash flow statement looks like. You can see that here on the right, It says a cash flow statement summarizes the amount of cash and cash equivalents entering and leaving a company. The cash flow statement measures how well a company manages its cash positions. And you can see how it shows you the cash beginning of period, $5,500, the net income, the depreciation, increase in accounts payable, all the way to the cash at the end of the period, $6,000. Now, just another quick example of what restructuring versus reengineering means. So restructuring will streamline hierarchy of reducing number of levels of hierarchy. It tries to eliminate redundancy, downsizing the workforce to lower operating cost. Now, re-engineering, on the other hand, is fundamental rethinking and radical redesign of business processes to achieve dramatic improvements, usually for customer satisfaction. It focuses on processes which cuts across functions, not on functions. Now, with re-engineering, think of how Amazon sometimes, if a customer wants to return an item that is like $5 or less, they might tell the customer to keep that particular item because it might be more expensive for them to have that returned than if the customer kept that particular item. That's a re-engineering of that process of returns. Now, reasons to restructure and downsize: change in the business environment, excess capacity, bureaucratic costs. The organization has probably grown too tall and inflexible to improve competitive advantage